Hey guys, Freaky Finance here. Last week we looked at Alibaba, and this week we're going to look at AT&T and talk about the recent merger deal that was broke on Monday, May 17th, 2021. So unlike other channels, the first thing we're going to do is just dive into the annual numbers because I think that helps set the stage. So AT&T has four main segments. Most people know it for the communications division, but inside each segment there's quite a lot going on, so we're going to have to take a deeper look at each of the four of them. You can see during the COVID year, these are annual numbers, all the lines were down. But there's a lot going on. Some things are going up, some things are going down, and it's kind of interesting to see the differences in that. So we're going to jump through that in a bit. Corporate and other looks like something that's not important, right? But there's some important segment in here that's buried in here, which is interesting. Company's revenue was down across the board. You can't really blame Time Warner. Theaters were closed. Latin America has been in decline for a while. In communications, you have a growing mobility segment, but then you have the legacy landlines and Wireline. That's what they call them, divisions. But at the same time, you have broadband in there. So there's a lot going on, but we'll talk about that in a second. So the company saw lower revenues, management respond, some COGS scaled. So they cut broadcasting down 3.8 billion. But I mean, your revenue in Time Warner alone was down 5 billion, and your revenue from communications was down about 3.5 billion. So they did try to cut costs, but negative scale. So they're down about 5 billion in GMD year over year. SGA did decrease, so there was a response, but it wasn't good enough when your revenue falls 5% in a year and you only cut 3% of your SGA, right? So, but they did try. There was a lot of asset impairment, so you're going to see the bottom line here looks horrible, right? There's a swing of $18 billion, $19 billion, but you can see the delta here. 17.4 billion is impairment delta. So they impaired a lot of assets during the 2020 fiscal year. Depreciation expect pretty constant. Just to point out, that's a $28.5 billion in depreciation in 1 year. That's what, 500 million a week? It's a big amount, right, of depreciation. Depreciation is non-cash, so AT&T isn't good on a PE perspective, but it's really good on a cash flow perspective, right? This is like a case study for that. You can see interest expense did decline by about 500 million. They were reducing their debt during the year. They've actually been doing that for 3 years, really, since they acquired Time Warner. Been reducing their debt, and it has been saving them in interest expense. They recently increased the debt again, but now they've reduced it again with this recent deal. We'll have to see where this shakes out in the next couple of quarters. Though the new debt they were able to get for their 5G rollout spectrum and C-band wasn't high interest because we have low interest rate environment, right? So it's low interest rates for AT&T really help AT&T out, especially if they can refinance at the lower rates, which they should be given their debt load. So you can see the share price, how it reacted. I had 29.57. I think it closed closer to 30 actually on Friday. Today is May 22nd, 2021. But you can see the share price did react during the year. It was actually cheaper during the COVID panic, and it's kind of sat in a range. AT&T doesn't move around that much usually. It's more of like a staple dividend stock, right? And we'll go through and see kind of, because it does have fairly steady cash flows. You can see the company's about $70 billion cheaper in equity market cap, because it went from 39 to 29. Assets less Goodwill, so they did impair quite a bit of assets, so that shows up right here in Goodwill. You can see there's 11 billion less in Goodwill. I did find it interesting that depreciation is 28.5 billion, but PPE is only 127 billion, so quite a lot of capex that they're constantly having to put back in the business. That's what that tells me, right? Pretty much depreciating, like, what is that, a fifth? Yeah, a fifth of your PPE a year, assuming that depreciation is all PPE. But you can see total indebtedness did improve. That was kind of indicated by the interest expense decreasing year over year. CFO, most important thing for AT&T is the free cash flow and the cash from operations, and you can see that did go down. And that went down to 5 billion, which is in line with what we saw here with the lower GMD. So that was nice. Capex, they did reduce capex. A lot of companies were kind of forced to during COVID. What we might see is an increase in capex for a lot of companies in 2022. I didn't see that in anything, but they did guide a decent amount in capex, but I don't know how much of that is going to be Warner, right? So I need to see more information before I can say what their capex is actually going to be after this deal. But you can see free cash flow did decrease. Dividends paid was slowly increasing during 2020, and they bought back more shares at cheaper prices. So that was actually pretty good for them at the time, right? So at the same time, you got to remember this company's paying almost $15 billion in dividends a year. I know everyone loves the stock for the dividend or whatever. There's like an emotional response to it. But if I was if I was a CFO or a CEO of this company, I would have slashed the dividend and just paid down debt. I mean, you're 15 billion a year, 4 years, that's $60 billion gone, right? That's a lot of interest expense saved. Yeah, the banks might not like that, but or the shareholders who own it for the dividends, but that's what I would have done. GM percent did decline, barely. The main story here is the revenue growth decline, with SGA trying to decline, but not enough. The share price declined, as you'd expect, based on deteriorating fundamentals, but the company is now cheaper in terms of free cash flow. So the free cash flow is actually fairly resilient, right? Though again, part of that is this capex reduction, and I don't know how sustainable that is. You had a lot of mixed signals here. And the payout ratio at the end of the year was 54.47. This is just a note to myself because I was trying to go through, I went through the little presentation and I listened to their call and I was like, why didn't AT&T tell us how much they're saving by moving the debt to Time Warner, or sorry, the new co, rather, right? But at the same time, maybe they don't want to because they know that whatever they save is just the new co's expense, right? What else? I did want to point out, because a lot of people just view AT&T as like a growing debt story, and it did grow in debt during the acquisition phases, but the last 3 years they have been paying down debt. So the company has been improving until this last bit where they had to increase the investment into C-band. But you can see generally they were on track to pay about, that's 11 billion, that's 10 billion, that's 8 billion. So roughly 10 billion a year, we'll say, in debt, right? So they were on a trend, and we'll have to see how this extra spectrum buy versus the shuffling 43 billion of their debt onto the new co's books. Let's just finish off on the Goodwill thing, because I wanted to look and see, because that was a big impairment charge, right? $18 billion or $16 billion, whatever it was. So I wanted to see where they were impairing, because there's a lot of Goodwill on the book still, which should mean more and more impairments. I always kind of view Goodwill as like a bomb waiting to go off, right? It only gets impaired. It never helps. So it's not a real asset at all. So they recorded 7.2 billion in long-lived asset repairment in the video business. We'll talk about the video business. And then they try to break out. So 1.2 billion in customer lists. That's kind of funny, right? What else? They impaired Goodwill allocated to video 8253. So you can see that right here in the communication segments. They impaired a decent amount of Goodwill that was sitting in the communication segment. And they also impaired quite a decent amount in the Latin America business, right? I mean, they actually, what is that? Impaired 60% of their Goodwill for the Latin American segment. And we'll talk about that. Those are the two weaker segments, so it makes sense that they're impairing them because they do look impaired. But again, the trick is, does this impairment continue and do you care? Because it's going to impact their EPS reported, but adjusted basis it won't, and cash doesn't have an impact. So one of the main thing for AT&T is cash. So there's a lot going on in my head on this one. I don't own AT&T, though it does look interesting in cash flow terms. So I did want to check, this is just their overall statement, and I just wanted to check their adjusted EBITDA, see if it made sense. In 2019 they did 59 billion, and then in 2020 they did 54 billion. So a decrease of about 5 billion, which is what we thought, because when we did the GMD shortfall, that's pretty much what it fell by. And all the other things were kind of offsetting each other. Let's see the headcount decline, pretty interesting, because I didn't see that kind of cost savings in the quarter when you kind of go from 260 million, when you go from 262,000 employees to 228,000 employees, right? You'd expect to see, and this trend is continuing, right? So they are cutting costs, though I wonder how much of SGA didn't decrease because they were giving payouts to people, right, as they were cutting them. But you can see that they are trying to manage costs, and that's what, if I'm trying to invest in this company, that's what I'd want to see, right? But at the same time, shrinking employees means that shrinking in business usually, right? Nothing ever comes easy. These are the segments, so communications, WarnerMedia, Latin America, and corporate and other. You can see in terms of revenue as well as EBITDA. So EBITDA is probably more important. So let's just go down here. You can see that of their 13.5 billion in the latest quarter, Q1 2021, you can see adjusted EBITDA was 13.5 billion, and 11.4 of that was in the communications business. So that's about 85% of their adjusted EBITDA is from communications. So the other companies like WarnerMedia, it's a decent amount, but it's smaller than their business Wireline. So that gives you the context of how big WarnerMedia is and the context of how big AT&T is. Here you get a good trend. So you can see mobility actually slowly increase. You can see the business Wireline slowly decrease, kind of bounces around a bit. Then you have consumer Wireline, which is decreasing, and lately it's been kind of holding its own. And we'll go into these subsections in a bit. WarnerMedia, you can see, it's been holding about 2 billion in EBITDA quarter, so about 8 billion a year. And that's not bad, right? You got to remember COVID's in here. Theaters were closed. And before COVID, they were doing about 3 at the peak, right before COVID, right? Yeah, that's Q4 2019. And then you have this smaller Latin business. I'm surprised they still break this out in a segment. You can see it's been in decline, and this EBITDA is almost, well, it's immaterial relative to these segments, right? You're talking millions of dollars instead of billions of dollars. Corporate and other. So this is the interesting one. So video's in here. And video, you can see the revenue up here just getting destroyed, right? So going from 8 billion in revenue a quarter to 6.7, lower lows consistently, right? So this is a grading segment, and they moved it into the corporate and other, which I thought was kind of interesting, right? Because corporate and other in my eyes is usually like a brush over. But when they have this huge amount in here, I'm like, okay, because it's not small, right? I mean, 6.7 billion in a quarter. That's technically their biggest one in revenue terms, aside from Times Warmer as a segment, besides their mobility business, right? But anyway, you can see that the EBIT has also been declining quite a bit. The good side, so mobility, this is the reason why I'd want to own it. You can see subscribers and connections going up quite a bit, but then you have the ARPU down here that actually started decreasing right around COVID time, right? So we see this $50.5, $50.6 per month in revenue per user on average. And then you see it slowly go down, 49, 49, 49.50, 49.1, right? So going down. And one of the things that I think is interesting, because we saw this when I did the Bell Media video, is that ARPU declined as roaming declined as people shut down. It didn't have extra roaming charges or anything incremental like that. So what I think is going to happen is that AT&T is going to have a hidden reopening play on their ARPU. Not huge, right? We're talking about $1, right? But it's $1 per month per user, and they have half the American population. So you get a decent amount that's hidden in margin expansion that the company doesn't have to do anything extra to earn, really, right? On the wireline business, so wireline, self-explanatory, there's a wire, not as good. So you can see business, this is the business segment side. It has been holding pretty good, but there's no doubt that it's slowly decreasing, right? You can see operating revenue go from 6.4, 6.5 to 6. So it is decreasing, but it's holding its own better than I thought it would. Especially during COVID, I thought more people, especially businesses, would have cut to save money as they work from home. But that's just my random thoughts. EBITDA, though, fairly steady, right? So they've been able to offset a lot of the revenue decline by probably cutting employees. That's just my conjecture there. On the consumer wireline side, so the non-business, you can see there's mixed in here. So you have IP broadband, which has actually been increasing. Not bad, right? Actually about 10% growth in revenue in 2 years. But you can see the overall revenue has been declining. Their IP broadband is trying to offset this legacy voice and other. I hate the word other. But anyway, you can see they're trying to offset each other, but these two are in decline, and IP broadband's in increase. Eventually, what's going to happen is these numbers are going to get so small that this increase is going to outpace these decreases. So you should see consumer wireline slowly pick up, but mainly that's really IP broadband. And you can see that here, where the growth is, it's in fiber. That's why the company's focused on fiber. So you can see non-fiber going from 10.7 to 8.5, right? So again, you have these two offsetting things. You have them trying to put a band on fiber, and you have them reducing them on fiber. I did find this one interesting, that the average revenue per user has actually been increasing. They are getting more revenue per user on fiber. That's a hidden trend I don't think is showing up in the numbers, because these things are just in so much decline still. Eventually this decline, just because it's declined so much, eventually the problem's going to eat itself to zero, really, right? And then you're going to get higher margin on the IP broadband as it keeps growing to offset it. So it's going to be an interesting time in the next years anyway for consumer segment. The WarnerMedia segment, so this is the one they just spun off. It generates a pretty good amount of revenue and actually held up fairly good during COVID. They did a peak at 9.4 billion in revenue in a quarter. They did 8.5 in the latest one. More importantly, you can see down here the EBITDA. But you can see that went from about 3 billion to 2 billion a quarter. 4 quarters, that's about $8 billion, a little bit more. The new company is going to have a decent amount of EBITDA generated from the Warner assets. What else did I find interesting? Oh yeah, so the DTC. So this is like your HBO Max offering. The main thing I liked here is that it breaks down the global and then the domestic and international subscribers. So I keep seeing a lot of numbers like, well, HBO only has 44 million subscribers, and that's what a lot of charts show, even their own, right? And then you see that they also have a decent amount that isn't growing in international. Interesting thing with HBO is the ARPUs are decent. So you're getting $11, almost $12 on revenue per user per month, right? If I compare that to, say, Disney, who's been pumping out subscribers, right? You hear how successful it is. They have more than 100 million now, right? You can see that their average revenue per user continues to decline. So if you pay Disney, you're only paying $4 a month. I know most of the people watching this video say, no, I pay a lot more than that. That's because they juice the subscriber number by going international. So more than a third of their customers are in India. So it increases the sub count, kind of juices it a bit, but it lowers the revenue per user per month, right? So that's something to keep in your back of your head. A lot of people that just throw these subscription numbers out saying how successful they are, you got to remember where they're growing, what that actually means. So Latin America, they still break it out here. It doesn't look good. They're declining fairly steady across the board here. A wireless actually holding its own, but you have this video entertainment segment that's just decreasing. In the video, so that's where they swept into the corporate and other. You can see the decline, right? Going from 8 billion to 6.6. You can see the EBITDA margins kind of all over the place. The interesting about video, aside from the number of connections slowly decreasing from 22 million to 15.8 million, is the here right here, the ARPU, premium TV ARPU. People pay a lot in premium TV a month, which kind of I had to take a double check. I was like, wow, that's a big number, right? But anyway, the number of subscriptions just keeps going down. So you can see, well, they're trying to get more money per user. You can see that the user count continues to decline, and the overall effect has been negative in terms of EBITDA generated on average. So this thing's in secular decline, but I did find the ARPU kind of interesting, right? That literally goes from $115 a month to $135 in 2 years. So yeah, the mobility still on the wireless side. Obviously, this is the slide where they're showing the 3 things that are growing for the company, right? Because I showed you quite a mixture. This slide is literally for growing in wireless, for growing in fiber, for growing in HBO Max. And we just sold HBO Max, but this was Q1, so they didn't tell us that at the time. But you could see that they're trying to say, oh yeah, we're doing good. Yeah, you're kind of doing mixed. So the transaction itself, I kind of rambled, I think, for like 20-something minutes just on the existing business, but there's a lot going on. So AT&T, most people know, basically AT&T shuffling $43 billion of their debt to Time Warner, or WarnerMedia, but they get 71% of the company, which I think is a good deal for AT&T. A lot of people get hung up on this $43 billion number, and they think that's all it's worth. But no, you're getting 71% of a merged HBO and Discovery, which are also growing materially, right? And I think consolidation in industry just makes sense. So I actually like this deal. So again, I don't know if I want to buy AT&T here or if I just want to buy the spin-off company if there's enough hate when it comes out, when this deal closes in the second half of next year. The brands, most people talked about this because it's easy to see the images, right? They do have a decent amount of brands, right? A decent amount of content. Content's always hard to judge. I do like how they have NHL and stuff like that on there. I actually view like these sports franchises, the cost of the licenses for these companies is just going to keep going up because you're competing now with Apple and Amazon, who have unlimited amounts of money. So I think these expenses for these type of licenses just increase, though their internal content is strong, right? Like, I mean, I don't watch TV, so it's hard for me to judge. So post-transaction is kind of their theme. So they're going to accelerate their fiber expansion. I think that's smart. 5G, I think, is smart. So I like this. An attractive dividend, yeah. Sure, that's what they got this year, or this week. Though to be fair, they kind of blindsided the people that wanted the dividend, in my opinion. You can see it go down to 40 to 43%. They were just at 54 and a bit at the end of the 2020 year. So that's quite a drop. Doesn't sound like quite a drop, but it is quite a drop in terms of dividend yield. And then you have the debt reduction, and they did accelerate it. So they're saying we're actually going to be able to get 2.5x by the end of 2023. Before it was 2.5x at the end of 2024. Kind of already talked about mobility and fiber. Again, they're like harping on the 2 things that are growing. Now that they sold off Time Warner, they don't have 3. What else? Oh yeah, so this is one of the things that I like, is so when people on the media are just blasting companies, I always try to get, okay, this company is now hated, I can probably get it at a good price. So this is going to, like, AT&T is going to be in my back burner if I see more freak out and weakness in general, right? I would watch this video, Jim Cramer, on May 20th. I think this was really funny. He really harps on the management and on dividend cut, which is fine. But the one thing I think is around 6:30 in the video, he kind of says that Time Warner was bought for 80 billion and now they're selling it or spinning it out for 43 billion. And then he shuffles the 71% of the new company kind of to the side. And I think that's what the general media is seeing, is that they think the deal is a loss for AT&T. They bought a company for 80 billion and they're only getting 43 million for it. And that seems to be what I'm like, it's not what they're saying, but it, like the tone, that's what it seems like. And that's what I'm excited about. So if they can convince people that that's true, then this company could get cheap. Then I could buy it at a nice discount. They're obviously not selling it at a loss, or else they wouldn't make the deal into a reverse Morris trust. Basically, that's just a way to evade corporate tax when you sell an asset. I don't think evade's the right word, but basically you avoid paying taxes using a strategy. And you wouldn't pay taxes if you were in a loss. You would actually take the loss, right? So no, AT&T made money on this deal and it is value accretive to shareholders. But if we can convince people that it's not, then I'd be interested in buying this company. So we'll have to see how much the dividend holders really have to sell this company now that it's not yielding the dividend yield they wanted. It's still yielding a decent dividend in the context of the overall portfolio of dividends that are out there. On their latest call, so in April 22nd, I think it's just, a month before this earnings release, or this deal release rather, you can see net debt was 3.1 times. They're trying to get at 2.5. They said this is going to be their peak debt. It's up to you if you trust them. But it probably is their peak debt based on their debt trajectory. I did find this funny. So this is one of the reasons why I was like, if you trust it. So they talked about being able to sustain their dividend at current levels just 3.5 weeks before they cut it by a material amount. So, I mean, that's always kind of a red flag if you're a shareholder. Like, okay, do I trust this guy or not? I do kind of want to see what they're thinking with mobility. They didn't come out and say that they're expecting higher ARPU per user on the wireless side, but I think when you're reopening, you have roaming, you're going to start seeing that. And then the reason 5G is exciting, why I liked it on the Bell video, and the Rogers kind of talked about both, is that 5G is data intensive, and the more data you have, the more people are likely to shift to unlimited data, or at least that's what I'm thinking. And if that's true, then you can see here that buy up on unlimited plans. So they make more money on unlimited plans in general. Unless the guy's incurring a lot of roaming charges, then they make decent money off that guy. But if they can get more people on unlimited plans, which should correlate with 5G because it's data intensive, I think they're going to get some more ARPU, and that trend's going to start increasing again. So that's the hidden strength of wireless. That's what I like. But I mean, you got a lot of hair. The headlines, I always like to see kind of what's pushing. So you can see some people really like it. Some people hate it. If you're a dividend holder, like Cramer kind of talks about the grandma that's holding AT&T for the 7% yield. But you can see why they're doing it, right? They literally just gave away $8 billion. Not gave away. They peeled off $8 billion in EBITDA into the new company. So, I mean, where's the cash going to come from? Are they going to take debt to pay dividends? No. Anyway, so the share price got hit. It did bounce back a bit during the week, at the end of the week, to 30. But it did print in the 28s for a bit. It's kind of funny. It's kind of polarized to growth stocks, right? Like, I think the middle of February was when a lot of growth stocks peaked. And you can see AT&T started to slowly increase because people view it as value. And it is in terms of cash flow. It is good. Well, cash flow multiple is like 7 or something. So I did find this interesting as well, that the news broke on 17th of May. And you can see Viacom's, during the day, it was kind of mixed, actually negative. But the next day, when people were freaking out about AT&T, there's a lot of buying on Viacom. So this is interesting. So that's not a small move, right? 10% going from 38.40 to 42 in a week. You kind of see what's happening right now. There's people thinking, okay, there's going to be more consolidation in this industry. And I think that makes sense, right? You got the Apples and Amazons and Netflix that have high share prices that could easily just take out some of these legacy content. And these content providers are big, right? Like Viacom looks small. And it is small relative to those other guys, but they make a lot of content and they have a lot of studios. So it wouldn't surprise me if there's more consolidation. Who knows what could happen, right? So Viacom's starting to look interesting to me, and I look for things like these kind of changes because it's been kind of dead since the bubble burst for Viacom. But don't get me wrong, even at 60, I think this thing was only at 20 times earnings. I think right now it's at like 12 or something. So still a cheap company because people view it as a struggler. But it's starting to look interesting. And actually Viacom, just for interest, has actually been pulling cost out of the cost structure for a while. So it's starting to look very interesting to me. So I'm probably going to do a video on that at some point. But I just wanted to bring that up because I noticed that rate of change in Viacom. But anyway, I'd like to know your thoughts. It kind of went through a lot of information. There is a lot going on with AT&T. Like I said, I'm not going to buy it right now. Ideally, if the media could drive it down, I might look at it and buy it. I am interested in the spin-off company. Oh, and I almost forgot. Since it's a long weekend, I'm probably going to do another video. Just a little update to see the holdings, what I'm currently thinking. So I'm going to do that. It usually doesn't take too much time to do one of those and pump that out since I got an extra day this week because I'm off work. So anyway, have a great rest of your week.